So I just want to encourage you with that. God is able to equip you and supply all of your needs according to his riches in glory. Amen. So the first thing we're going to look at, I'm going to talk you through 4 different sections. And as Manning said, we can have a little bit of questions and answers time at the end of each section. The first section, logically, would be to help you to understand if you're setting up businesses, or even if you're in businesses, how do you start to cost and price whatever it is that you're selling? Some of you are going to be selling products that you might have to create or make. And the screen you'll see with the spreadsheet on is showing Fashion Asia. And this is a business that's going to be selling articles of clothing. So there will be an element there where there'll be products, there'll be ingredients that will need to be put together, and there'll be labor involved as well. Some of you might just be selling yourself as a service. And obviously that's a lot easier to do a costing for, because essentially the primary cost there is yourself, is your labor or other people's labor. But if you follow the principles, the same will apply. And the best way I like to describe this is, which is quite apt for you guys in Chennai, is to suggest to you, if you were making a curry and you had a great big pot that you were putting all the ingredients in, there'll be spices, there'll be chicken, there might be rice, there might be, I don't really understand all the things you would put in there. But the one thing is this: you've had recipes passed down from generation to generation, and you know that if any ingredient is missing from that pot, it isn't going to taste quite the same as it's meant to taste. And this is how you produce your costing. That top section that you're looking at on the screen is essentially, this is your pot. This is the pot of ingredients that go into what you're selling up here. So if, for example, you had spices, or you had meat, or you had rice, or whatever it looked like, they would be going down here, because you cannot sell this section here until you know what your ingredients are going into the pot here. And so I want you just to remember that analogy and think about whatever your business is, whatever it is you're producing, what is it that has to go into your pot in order for you to be able to sell it out? Okay. And this pot is called your cost of sale pot. And it's kind of those ingredients that you cannot do without. Underneath the cost pot, you'll have all of the other things that make up a budget. And we're not going to talk about these things just yet, but these things are incidental costs. They're not your direct costs, because these things don't go in the pot. They happen around the pot. And if you imagine your pot is now on your stove, you've got some point you've got to buy the stove. Then you've got to have electricity that will power the stove. Then you've probably got a kitchen that you're using to put the stove in. And you're probably using some tools such as knives and forks and spoons and all sorts of utensils to be able to also work with that pot. These are all what we call the incidental costs. But what I want to focus on right now is this section, which is the cost of sale. Okay. So with this Fashion Asia product, I'm going to take you onto what I call the pricing keys. And this is a really useful way. And obviously you've all got this spreadsheet sent to you by email. So you can utilize this, you can add figures in, you can change figures. All I would be very careful of is you'll see a lot of formulas in there. And if you don't understand formulas that well, you might need to just play with the items that are not formulas. These are the variables, but these are the formulas. Okay. So take, for example, a blouse. So what I've been told when we've done this pricing structure is that this blouse was going to take 2 meters of material. There was 0.5 of a meter of other materials. And the cost of these materials at the top there was £4 per square meter. So once you've got that price, those variables there, and you know the cost, you know straight away how much your material cost is going to be. We also know that it was going to take 3 hours for somebody to make that blouse, and that allows us to put in a labor cost at the top, and this is where you can change this. This can be whatever your labor cost is, in the same way as this £4 here, sorry for those in different currencies, that £4 can be whatever your material cost is. So if I change that £4 and I make that, I don't know, £2.50, it changes everything. Okay, so be wary of changing these formulas, but you can change these things and it'll change the whole budget and the whole costing. So on this occasion, the blouse is going to take 3 hours at £8 per hour, which is a £24 cost. We've calculated that there's a 5% packaging cost against everything that we sell. And so these costs are factored in at 5% of the material cost. We then know that there's a wastage element, because if you imagine, if a blouse was going to take 2 square meters of material, it would be a bit risky to start with 2 meters. You might start with 2.1 or 2.2 meters. And so we allow for a little bit of wastage. And again, that's something that you can change as you're costing. We then get a subtotal for all of the material costs and the packaging and wastage. We then realize that actually you're using a third party to sell your product. Now that third party could be Amazon, it could be eBay, it could be a retail shop somewhere. Whoever it might be, you can put in a percentage of commission that you're going to be paying them. We then arrive at a total cost. And then we've got a whole section here for marking up your cost into your selling price. Now, the one thing I would say is that your selling price, it's very easy for me to put here, mark it up by 50%, 60%, 100%. But ultimately, your selling price is going to be dictated to by your industry and the people who are going to buy it. So it would be very, very little point in us trying to sell that blouse for, I don't know, let's say £109 when you could get them down the market for £20 or $20. So you have to understand that there's a price sensitivity set by the people who are going to buy your product and by the industry that you're in. But this tool will allow you to see how much you can potentially make as a margin on the products that you're selling. Over this section, we just thought we'd add these ones in because if, for example, you did want to sell your blouse and it was a very good quality material and you were very confident that you could sell it for £150 or dollars, you would then know what your profit was and you'd know what your markup was. So if you decided, actually, we're going to sell that for £80, it changes everything. And the reason I like this kind of pricing keys approach is that everything in this budget relates to these prices. So for example, if that blouse starts out at £150, in my budget, my blouse sale proceeds is going to be 100, 200, 300, 400. But if I change that blouse sale price to say £70, they're all going to change. Oh, they're supposed to change. Oh no, sorry. It's because the quantities, I've got them in here. So you can use this tool at the top to do your costing exercise. And then what we'll do is we'll go on to a sales quantity schedule, because it's one thing to know what your costs are, but the second thing you need to know is, well, how many am I going to sell, and how is that going to cost out in the final budget? So for example, we've said that we're probably going to sell one of each of these items in January, two of each of them in February, 3 in March, etc. And what these sections here do, they're all pre-formulated to allow for the quantity to be multiplied by the actual costs from the pricing keys section, and therefore reflect in the budget. Now this looks quite complicated, and I totally get that. What I would suggest is that you just work through this tool, get some understanding from how it's knitting together. And if you've got some products that you're selling and you want some help with trying to replace these kind of items with your own products, please let me know. Get in touch, drop me an email, and we can spend some time together just going through how this can be adapted to your specific industry and your specific business model. But we've done a lot of the hard work here by presenting this to you so that you can start to input your own costs, input your own markups, and obviously this will all be calculated through the sales quantity and therefore end up on the budget. So that's a quick introduction to costing. And if we just take some questions now for a few minutes before we go on to the next section of budgeting.
Hey, Frank here from Chennai. Dave.
Hey, Frank.
So on the wastage cost, are you calculating the wastage just on the materials, or are you calculating the wastage on the entire package, including labor and cost?
No, the wastage cost is purely on the material, because the labor, that's a precise figure. So we've budgeted that it's going to take 3 hours to produce that blouse. If it actually takes longer, then either we've got something wrong in the calculations of the original costing. It's more likely that these times here should be the maximum time it should take to build your product. And really, we would like to think that there would be, over time, if it takes 3 hours to start with to make that blouse, we'd like to think that that time would come down to maybe 2.5 hours, 2 hours, to improve your efficiencies. The packaging costs are kind of just done on a percentage basis. So again, we're not building wastage into those. They should be fairly accurate. But again, the packaging cost could be, in your industry, it might be 1%, it could be 5%, it could be 20%. So that wastage is purely on the material that you're using.
Right. Okay.
Any other questions?
Yeah, I think, like you said, this is a template, and based on everyone else's business, we need to kind of tune it to our liking, and then maybe get back to you for any custom change that we think we are struggling with. Yeah,
absolutely. Yeah, I would play around with it. For example, let's just say, I mean, there's so much you can do with this. I mean, let's say you were, I don't know, what's somebody selling at the moment? Give me an example.
A food product, a commercial, yeah, a commercial food product, maybe a powdered mix, more than 5-6 ingredients.
What? Sorry, a bowl of mix.
A powdered mix, maybe like Horlicks.
I'm not sure what that is, unfortunately. So I'm going to call it a curry.
Okay.
So in here, you would probably, you could have in your materials, your meters materials, this would be your curry ingredients. Now, the thing is this, you can add lots of different columns in here to cover all the different ingredients. So if, for example, you wanted to increase your selection of curry ingredients, this could be spice 1, this could be spice 2, this could be rice, this could be whatever the vegetable is. And you could literally put in all the different costs in here. That might be £2, that might be 1, that might be 50. And what you would come to is you'd have a total. And all you need to do is slip in there a little adding up of all those ingredients to get to your total ingredients cost. And again, then everything else can stem from that. Does that make sense? I'm just getting rid of it because I don't want to lose what I've previously got. So we can adapt this for any type of industry. But what I would say is, obviously, at the bottom of our email that we sent to you, we've given you that invitation that if you wanted some help producing your own budget and make this more bespoke to yourself, we're more than willing to do that. So just get in touch with us, send us an email, and we'll set aside some time to do that for you. Is that okay? Any other questions on costing? Frank, I can't hear you, sorry.
Yeah, sorry. I think we haven't included on the pricing keys, like the vendor side discount for the, the quantities that are being ordered. For example, like you said, if you're forecasting, a certain quantity at July, maybe for that number of quantity, there's a vendor discount of 10%, right? So maybe that needs to, is that something that?
Absolutely. And to be honest, Frank, I probably wouldn't build that into the keys here. I think this is these are your base costs. But what I'd probably do in the budget is I'd probably insert a line, and we'd call that discount, and we'd have a separate calculation that would try and work out how to calculate that. This is really about your pot. If you think of this as your curry pot, these are all the ingredients that go into your curry pot. These are the materials that would go into making, let's say, a foam. So you'd have glass material, you'd have plastic, you'd have silicon, you'd have all sorts of different ingredients that would go into the making of that foam. So this would represent all of the materials, some packaging costs to send it, an element of wastage. If you were to throw things like discounts in, because they're not appropriate for the whole of the year and for all of these products, you'd want to show that separately on the budget.
Right.
And I get that there are a lot of discounts that get offered at different times of year, specifically if you're a seasonal business or based on quantity. But we're starting to get into the realms of more bespoke calculations then.
Right. Got it. So you're suggesting a discount to be added on the budget side, not on the pricing key side.
Correct.
Okay.
Unless it's, I mean, if it's a discount against everything, then really it's not a discount at all. If it's a discount for specific times of year against specific quantities, then definitely that just needs to be brought into the budget.
Right. Okay, Dave, thank you.
If there are no other questions, I'm going to go into the budget now. Is that okay?
Yeah, hi Dave. I just have a question.
Okay.
So here, are we just talking about the production cost, or where do we, is this, we can put in the marketing cost as well here?
Yeah, that's in the budget. So we're gonna cover that now, next.
Okay, right.
Cool.
Sure, thank you.
Okay, so we'll move on to the budget side. So once you've created your pricing keys and you've managed to cost out, as accurately as possible, how much your products are going to cost to make, to package, etc. You know roughly what your sales quantities are going to be. And don't forget, a budget is something that's dynamic. It's not a static tool. And what I mean by that is it can change. People think a budget is set for the whole of the next year, but that's not the case. It's produced on your best estimates at the time. But obviously, if we'd have done a budget for 2020, none of us would have anticipated that we wouldn't have had any work in April because of what's been happening. So your budget needs to be something that's dynamic. You can change it as conditions change. So if we go into the budget, we've already established our quantities for our products through the pricing keys. We've already established our costs through the pricing keys. And what we've arrived at is what we would call our gross profit or loss for each month based on those pricing keys and our best estimates of quantity to be sold. Also, I'm just going to mention this. Sometimes when we're creating a budget, if it's very sensitive on the number of days you have in a month, we might put up here, we might say, well, there's 20 working days in January, there was only 18 in February, there was 22 in March, and we might start to amend these figures depending on how many days there were in a month. And this is particularly relevant for you guys that are offering services, because like myself, I'm restricted by the number of hours I can work in any given week or month. And if I've only got 20 working days available to me in one month, my budget for that month is different to if I've got 22 days available. Once we've managed to establish the top section, which is our gross profit, this section is really saying we can't sell that without those costs. Everything that comes below, we could have an argument about it, but I'm not going to. I'm suggesting to you that most of these costs, if not all of them, actually are not crucial to the pot. They're not things that go into this pot, but they are incidental to the running of your business. So you will have costs for advertising. You will have an accountancy cost somewhere. You may at times get bad debts, but we're praying that won't happen for you guys. You may have computer costs and insurance, light and heat. These are all the incidental costs to your business. And only you'll really know what they are, because if you're working from home, then you have no office rental costs. You'll have no factory costs. But of course, if you are running from a factory or from offices, you need to build in rent and rates and those associated costs. So this is what a typical budget would look like. Once we get past the overhead costs, the administration costs, we'll then have a little finance section. And you'll see that we've got things like loan interest in here. So some of you may need to buy some plants and machinery to be able to build your products. And if that's the case, you may have a loan, and that will result in some loan interest. Then you get down to the owner's remuneration section. I'm not sure if you call them directors in Chennai, but limited companies in the UK and US, the owners are often called directors. And so we'd have a whole section based around their own remuneration. So they might draw some salaries, some taxes. I've actually got pension there twice. Don't know why, so I'll take that one out. And then you'll have some company tax that needs to be budgeted as well. So this whole document is designed to help you plan ahead. One of our favorite sayings is, if you fail to plan, you plan to fail. So if you don't have good business tools like a pricing key structure, like a budget, it's a bit like walking in the dark. You don't really know where you are. you don't really have a good vision for what your business is going to do that year, next year. So we really strongly encourage you to embrace producing some pricing keys and costings, to embrace putting a budget together. And as I say, we're willing to help with that. You just got to let us know if you need that help. Any questions on this type of budget?
Yeah, Dave, Frank here again. So if you're dealing with currency, different currency that is. So for example, the dollar is very, something very important to you, how much it is converted into Indian rupees, for example. Is there a way to look up on, because, dollar changes every day. Is that a manual entry that needs to be made, or is there a way that the Excel could bring it up from a source, from a website? Or
I'll be honest with you, Frank, different people adopt different policies when it comes to currency fluctuations. Some people actually say that if I sell this product, let's just say Chennai was selling a product to me in America, and you raise an invoice for me on the 1st of May for 1,000, whatever it is in Chennai currency, but let's say that was $1,000. If I took 2 weeks before I paid you, inevitably what I pay you is going to be different to what the value was in dollars the day I had the invoice. So you can, and that will be different to what you were expecting to be paid as well. So if you were expecting to receive 1,000 of whatever that, let's say dollars, and you only received 980, then you would manually in your own bookkeeping need to account for that $20 as a currency fluctuation.
Yeah.
So that's more of a case by case within your actual bookkeeping and accounting software. And again, some people base it on the invoice was valued on day one, let's say 1st of May. That was the currency exchange rate. And then when it was finally sold 2 weeks later, when it was finally paid, there was a difference and they record that difference. Other people actually only account for their income on a cash basis. And if you account for it on a cash basis, it means that you're only actually bringing into your bookkeeping the amount that you received. And if that's the case, it could be that you don't even have a currency fluctuation. So it does depend on your personal bookkeeping.
Right.
Any other questions on this budget? Do you understand depreciation? Good. I see some thumbs up. But just to say, depreciation is, don't be shy of. I've heard Christians in the past are very, very reticent to borrow any money at all, and I totally get that. I feel that that's more of a spiritual conviction. Generally speaking, in your business, if you're buying something that's an asset and it's going to last you for the next 3 to 5 years, the sensible thing to do from a bookkeeping point of view is to write that piece of equipment off over what's called its useful expected life. And therefore, if, for example, it was a computer, we would expect you to write it off over 3 years. If it was some plant and equipment, we'd expect you to write it off maybe over 5 years, or could possibly longer. And so what we do is in our profit and loss, or in our budget, we release the element of depreciation that's relevant for that 1 year only, as opposed to bringing it in as one cost at, say, £300 in that 1 month. It doesn't make sense to do that because it's an asset and it has a useful life. Any questions on the budget? Okay, so we're gonna move on from this budget into a couple of profit and losses that I've got. Now, you'll have to tell me if you can see them. Can people see that profit and loss? Thumbs up. Great. So what I've done here is I've just produced what would typically be a profit and loss on a balance sheet for two businesses. They're quite large businesses. This one is called ABC Limited, and they turn over $6 million. This one is a printing company, and it's turning over $1 million. And I just wanted to run you through a profit and loss and balance sheet so you get a better understanding of this is what your accounts will look like at the end of a typical year. You'll always start off with a sales section. Some of you might call that income. It could be the sale of products, or it could be the sale of services, but it's sales either way. We then get your purchases section. You might have some transport and carriage in there as well. This section here, this cost to sale section, could be the same as we saw on the Fashion Asia budget. And what we're looking to do is we're looking to gauge what things like gross profit looks like. How much is that percentage? And on the face of it, it looks like the printing company's got a stronger gross profit, whereas the air conditioning company's got a far bigger profit. And then we'll start going down some of the direct costs. You'd have, we tend to have two types of wages generally. You'll have what's called direct wages, and these are the people who are actually making the product or selling their services. And then down in the bottom section, we'd have administration wages, and those are people who might be doing your bookkeeping. They may be doing some sales for you, some credit control, but they're not actually physically producing whatever it is you're producing. So all of this section here are typically some direct costs that I see in clients that I work with. As I talked about depreciation earlier, this would be depreciation on the plant and equipment that they have. So for example, the printing company would have maybe $300,000 worth of printing press, and this would be a year's depreciation. We then have the direct profit, and you'll see that the air conditioning company is starting to struggle a bit now with its percentage, but it's still a very strong gross profit, sorry, direct profit. Printing companies stronger in that area. We then have a whole bunch of administration and overhead costs that again these are just typical things that I see in amongst my clients. So I've put as many as I could in there. Yours might only have 5 or 6 lines, and that's fine. The key to your overhead section is anything that you incur as a cost, anything you have had to pay for that's remotely connected to your business needs to be shown here, really. And sometimes that might not even be allowed for tax relief, but that's fine, because that's your tax accountant's job to determine whether it was fully allowable for tax or not fully allowable. I wouldn't get too worried about that. What I would say is if you incurred that cost in the process of your business, then it needs to be shown on here. We then get down to the finance charges section. And this is where I was saying that you might buy your machinery over a period of years. You might take out what's called hire purchase interest or lease interest. So you engage with a lender to buy that £300,000 printing press, and you might be paying it over 3 years. And so there will be interest on that, and that gets released through your profit and loss as hire purchase or lease interest. You may even have a building, in which case you've got some mortgage interest on the commercial property. Then we have the director's remuneration section, again, like we did before. And interestingly, what we've seen here is that even though the air conditioning company started out looking really strong in its gross profit because of the nature of that business and the size of its overheads and its direct costs. By the time we got to the very bottom, we find that actually that was a company made a small loss, and it was a printing company that made a reasonable profit. So don't judge a business by its size or the volume that it's sending out, or sometimes even by its gross profit. You have to see the whole picture before you can see what's really going on in that business. What I want to do now is move on to the balance sheet. And again, same two companies. You've got an air conditioning company, you have a printing company. And what we'll see in their balance sheet is that it's comprised of generally 5 sections. The first section is a fixed assets section. And this section represents all of those assets that you buy that can be spread over several years. In the case of a freehold property, that could be spread over 20 years, 30 years. Most of the other things would be between 3 and 5 years generally. We then have current assets, and these will be your stocks, your work in progress, your debtors, the people who owe you money, some other debtors. You may have some taxation debt that is owed to you. The bank account monies would be in there. The director's overdrawn account, I won't spend too much time on, but if you take more money out of your business than the business has actually paid you officially, that's you running into an overdrawn position, and technically you then owe the business that money. We then have a section 3, which is current liabilities, and we have things like a bank overdraft, mortgages, the people who you owe money to for your supplies, your materials, or your curry ingredients. We may have a facility in place. This, I'll change the name there because it's probably easier. This is called a factoring facility. I have clients that experience quite high growth in their business. And what happens when you experience high growth, and this is a word of warning to all of you, if you experience very high growth very quickly, you could find yourself in a position where your cash flow is being sucked out of the business because you're having to pay for wages and product before you get paid for it. So you need to be very careful as you're growing businesses. You need to, this is why you need cash flow forecasting, because you need to understand if you have, let's say, $10,000 in the bank and you pay $8,000 out to buy some product because you've got a lot of work on, it's going to be very quick before your cash flows run out, and you might not get a return on that product for maybe 3 or 4 months. So you need to be very careful with your cash flow planning. For this business, they chose to factor their debts to a lender who basically buys their debts off them and allows them to have 80% of that back in their bank. Then we have things called accruals and other creditors, your VAT if you're in the UK, or your taxes, and any monies you owe on finance for your machinery. This whole section is current liabilities. The one above is current assets. And what we have is some specific formulas that will allow you to understand whether your current assets and current liabilities section in your balance sheet is healthy or not healthy. For example, one thing that you need to be very careful of is not overstocking. If you were Fashion Asia and you're selling maybe 5 meters of material a week, it would be very silly of you to go and buy 100 meters of material up front and find it takes you the next 3 months to sell that material, because it could cause you to run into a cash flow problem. We'll talk more about that later. But stock turn is how quickly your stock is becoming cash. And it's usually based around your net turnover. And what we do is we take the percentage of your stock value, divide it into your turnover, and then calculate that as a ratio over 365 days for a year, and find that that comes out at 15 days for ABC Limited, but it's 91 days for XYZ Limited. If your stock turn is under 30 days, that's brilliant. If it's under 60 days, it's still okay. But if you're over 60 days, you know, that's not good. And the same applies to debtors. If you're taking longer and longer to get your debtors to pay you, some of you probably won't even have debtors because your business might be cash. For example, if you're a retail shop, you don't expect somebody to come in and take some shopping out of your shop and then not pay you for it for 30 days. You're going to get them to pay you straight away. Whereas a lot of bigger businesses would tend to have very regular, reliable customers, and they allow them to pay them up to 30 days, 60 days. And this is where these debtor days calculations come from. The current asset, current ratio and the quick ratio, these show the health of your business in a way that no other formula will. Your current ratio is very simply how many times will your current assets pay for your current liabilities. If your current assets are less than your current liabilities, you've got a problem and we need to talk. If your current assets are greater than your current liabilities, then you're the right side. That's good for you. And the greater this current asset figure is compared with your current liability, the better. And you'll see that I've said here that if you're under one would be 1,425,000 divided by 1,425,000. That would be 1. If it's under 1, it's bad. If it's over 1, it's good. If it's over 2, it's brilliant. And the quick ratio is very similar, but it just removes stocks from that equation. And again, if it's under 1, it's bad. If it's over 1, it's good. If it's over 2, it's best. Now, you might ask why I've gone into the detail of showing you this. And the reason is because this is where companies will go into liquidation. They'll go bust if their current assets are vastly less than their current liabilities. They have a huge problem. And this is the point where if you are the business owner and this happens, this is where you need to seek some serious advice on rescuing this business. This would be called a rescue business if I was looking at it, this one here. And I would need to come and sit alongside the directors and talk to them about how we can start to convert more business for them, how we can get these debts down. Maybe they're overspending, maybe they're not making enough money. But I just wanted to go through that because these are very important ratios for your balance sheet. The fourth section is where we get to long-term liabilities. Long-term liabilities would be, for example, a property mortgage, long-term finance, and I'm not even going to go there because that's too complicated to describe. But if you've got long-term debts, they would end up in the bottom section and not affect your current ratio. The final section, section 5, is your capital and reserves, and this is where your retained profits over a number of years are held, and also if you've got share capital, that's where that's shown. That was a very quick tour of the profit and loss and balance sheet. Open up for questions.
Yeah, Dave, how do you calculate depreciation? Because for an insurance, they have an approximate value for a car, maybe, the model it is, and over the years. So is that an approximate, or is that a formula for depreciation? Or
it can be a very simple formula, Frank. Essentially, let's just take a computer for an example, because everybody can relate to having a computer. If you bought a computer for $900 and you bought it on the 1st of June, then I would expect you to write that off over 3 years by an exact equal amount. So $900 divided by 36 months would be $25 per month. So in the budget, for example, where I have my depreciation line, that computer would be 300 here for the year, and then it would be $25 per month to write that down. So it is very, very precise formulas. Sometimes assets get what's written down on a reducing balance basis, and that simply means that you might start with $900. Once you've got to the end of the first year, your value is now $600, and you would write it down again by maybe 25%, and the balance literally will keep going on forever until it's less than $1. But that's a lot more complicated, and I'm happy to talk that through with anybody if they want to follow that up.
All right, thank you.
Right, I've got a couple of questions on the chat. Ruben's asked, are there a couple of common mistakes that entrepreneurs do while budgeting, something we need to be aware of? And the answer to that is yes. The biggest mistake that entrepreneurs make when they're budgeting is they don't take everything into account. It's as simple as that. You really have to look at any cost that could be involved in what you're producing. For example, if you are somebody who, let's say, for example, you're making those fashion items, if you haven't factored in that you're going to pay people like eBay or Amazon 2%, 3% to sell your product, or if you're planning to take credit card payments and your credit card company is going to charge you 3% privilege, if you don't factor that into your budget, you're missing something, and you're going to be making a lot less than you think. If you don't take into account the fact that you're going to be using electricity for producing those blouses and shirts and shorts, then again, you're going to miss that in your budget, and that's a genuine cost that won't be built in. So the biggest mistake that entrepreneurs make is they don't appreciate all the costs. Even things like driving to the factory to pick up your material, there's a cost to your car. You've incurred mileage, and that's a cost that you need to bring into your budget. So really, I guess the way to look at it is when you're planning your budget, you need to think of exactly what your movements look like in a week. What things are you going to be using? And that might even be your phone, your computer. It might be your car that you're getting from place to place to sell products or deliver products. It might be the fact that you need Wi-Fi in your factory or your office or your house in order to be able to take calls from people or even go online to record your bookkeeping. You might need a bookkeeping software product like Xero or Sage or QuickBooks, so that you really have to know and account for every possible cost. And that's why when I create a budget, if I go back to here, there are so many costs here, because I would rather start off with everything that there possibly could be, even if I know that in the end, well, we don't have industry dinners. Well, okay, we'll just set it to naught, and at least we've accounted for it. The second thing that I was asked is, if we're planning to increase salary for our employees over a period of time, how do we go about it on the chart? To be honest with you, your best option there is, if you remember, I said that your budget is a dynamic tool. It means that it's allowed to change over time. So if you're halfway through a year and you want to give everybody a pay increase from 1st of July, then all you would do in your pricing is at that, can we see that new schedule?
Yeah.
Yeah. So if halfway through the year you wanted to change that to 850, that's exactly what you do, and all your prices change accordingly. So and things will change. Your budget will have to change because you're buying materials from a factory somewhere. They might put their prices up. You need to factor these things into your budget. It's not that you need to take account of every cent or every penny, but you do need to take account of material changes to your budget. Hopefully that covers that. Any other questions?
Yes.
Yeah, I just want to know if there's any particular formula to distribute the overhead cost on a selling price of a single product.
Could you repeat that? I didn't quite understand what you meant. Sorry.
Yeah, how do you distribute the overhead cost?
Yeah.
On the selling price of a single piece of a product? Is there a formula for that?
The distribution costs.
Yeah.
So on the pricing structure, we've got things like packaging cost and we've got wastage cost. If you're distributing that product, what you could do is insert another column, and we could call that column distribution. And let's just say, for example, you'd calculated that was going to be 2% of the material cost. We would just factor in another cost in there, and that would, let's say, be relevant to the material cost. So what we've got now is a new column that's taken account of, for a £12 material at 2%, we've got a 24 pence charge. We would just carry that down and factor it in. So these columns are simple columns based around this particular budget with a fashion Asia product line, but your own budgets and your own pricing keys, you can insert as many columns as you need to be more bespoke to you. Does that help?
Second question.
No, I actually meant, like there's an overhead cost for a month, say some 30,000. So how do you distribute this 30,000 onto a single product? Like you're selling a product for 1,000 rupees. So
Yeah.
when you're selling it for 1,000, how do you factor this complete overhead cost of the month? So this 30,000, how do you distribute into that
Single
selling price of that single product?
Yeah. Are you saying that the 30,000 would be a cost, for example, every month?
Yeah.
Yeah. So really, if it's a fixed cost, these here are all variable costs because they all link directly to each individual product. If it's more of a fixed cost, then I would bring it into the budget and I'd probably insert a line. I mean, we have a line there for carriage. So let's just say, for example, that was your distribution costs. And what you might do is you might say, well, I know it's 30,000 a month. You might bring in 360,000. And then what you would do is each month would become 1/12 of that cost.
Okay.
Oh, you have to distribute into the entire year? Or?
Yeah.
Does that make sense?
Yeah.
Because some of your direct costs up here will be directly proportional, as we've shown here on the pricing keys. They'll be directly proportional to the number of products you're selling per item, but there will be other costs that will be fixed. They're still direct costs, but they're fixed. And so we would bring them in as a fixed cost and we would distribute that over the 12 months.
Okay.
And another thing I would say is if that fixed cost was directly proportional, but for example, to a sales quantity, for example, let's say it was the distribution cost was $1 for every item you sent out, then what you could do is in the sales quantity section, you could include a section that related that $1 for every sale that took place.
Okay.
And so, for example, the line would be $11 in January, $22 in February, $33 in March. And that would be quite easy to do as well, because all we would do in that case is this formula here would be relating to that number there. And so what I would probably do is I would just use that auto sum, relate it to that quantity. And if the distribution cost was, let's say, I don't know, $2 or £2, I would basically have that multiplied by that particular cost. And then we drag that across the budget. So there are different ways of bringing it in. It can be a figure that's spread over the whole year because it's a fixed cost, or it could be a fixed cost but directly proportional to the quantity. Those are some of these other things which are proportional in some ways to the amount of material needed per item. There are so many different ways of doing it, but to be honest, I think if any of you have got some budget questions and some pricing questions that are more bespoke to your particular business, drop us an email and let's get together for an hour and we'll talk it through. Any other questions on costing, budgeting, profit loss or balance sheet? Cool. So the last one I want to show you, and this is just to give you some help in understanding the differences between profit and loss and cash flow. Can everybody see that? Yeah. So what we've got is we've got two businesses. So I'm trying to get the appropriate size there. We've got two businesses. One is Great Business Tools and one is Poor Management Limited. Now, my first question to all of you would be, based on this section, which one looks like the one to be involved in? Which is the best looking company? And without answering, probably most of you would want to have this company here because it's got a greater gross profit. It's got a much bigger value of profit. And to be honest, I would probably jump on that one straight away. However, then we start to track down and we start to see their overheads. We start to get to the operating profit. There's a little bit more equalizing on the profits. But ultimately, even when we get down to, I'm going to move to this one, sorry. Even when we get down to the net profit at the end of the year, the margins are very similar, but we're still probably going to want to go for Poor Management Limited because we want that 85,000 profit in our bank. However, this is the impact that some cash flow issues can have on that profit. And the first one is when you buy assets and you're spreading the cost over, say, a year, 2 years, 3 years. If we move to the second spreadsheet, we have exactly the same starting point. But when we add back interest and depreciation, which is what you would do to convert your profit and loss into a cash flow projection, you would have to bring back the interest and depreciation because that's not actual cash going out the bank. And what you'd need to do is you'd need to bring in your loan repayments for the year. Then straight away, we see that actually this company here has lost more in cash flow than the other one. Okay. Then if we move on to debtors, what we find is that we've still got the same start profit. We've taken account of interest and depreciation and loans. This here is what will happen if you allow your debtors to increase just by 20 days. And I know that probably a lot of you in business possibly don't have debtors because you maybe are dealing in cash and your products are sold for cash there and then. But if you do have a situation where you start building up a customer base that are buying regularly from you, it's inevitable that they will start to want to have 30 days credit, 60 days credit. The impact on this business here to increase their debtors days by just 20 costs them 41,000 in cash. Whereas good management, or whatever they called that, great business tools, their debtors only increased by 5 and the impact was very minimal. So by the time we get to just 2 separate cash flow changes, already we're very, very similar on the cash flow surplus in the business. The third one is called work in progress. Work in progress happens if, for example, you had, let's take Fashion Asia, and you were asked by a customer to provide 1,000 dresses. It might take you 3 months to actually produce those 1,000 dresses. And what that's called is work in progress, because it's everything that takes longer than technically a day is work in progress. So to complete those 1,000 dresses, if it took an extra 20 days of that invoice before you could actually get any money in, it's going to cost your business 54,000 in cash flow. So for example, if you had a $1,000 order today and you got cash for it, there's no work in progress because you got the money the same day as you produce the goods. If you started producing the goods today and it took you 3 months before you can invoice and get your money in, it's already cost you greatly in your cash flow because you're paying your wages and you're paying for the product way in advance of you getting your money. The next one we'll look at is stock. And this is a problem I find a lot with clients, is they love to stock product. And the downside of stocking product is that it's as if you're putting cash on the shelf. If you're Fashion Asia and you stock 30 dresses because you're hoping to sell them one day, you've just put 30 dresses of cash on the shelf. Now, the good thing about having some stock is that if somebody wants something today or tomorrow, you've already got it. But you just need to be very careful with how much stock you're holding and be aware that, for example, in these two businesses, to hold stock for more than 30 days has cost that business 22,000 in cash. And now this business is starting to really struggle with its cash flow. The last one I want to talk about is cash flow draw-ins. And this is simply that if you as a business owner have budgeted to pay yourself, let's say $1,000 a month for 12 months. So that $12,000 is in your budget. You've costed it in. It's all taken account of. But then you go and take a nice little holiday to, I don't know, to Siem Reap. And it cost you $5,000. It wasn't planned for, but it's now in your cash flow. It's just cost you £5,000 of your cash. If you decided you weren't going to go to Siem Reap, but you were going to come over to Las Vegas and have a party for 2 weeks, it might cost you $35,000. And suddenly your cash flow is starting to look very, very poor indeed. So Poor Management Limited started off very well, ended up very badly. All of these things affect your cash, and you need to be very aware of those. Any questions on cash flow? Or is everybody tired after your hour of prayer earlier? Okay, if there's no specific questions on the cash flow, what I'd suggest is that we just open it up to any questions generally across all 4 areas.
Yeah, Dave. So what is a good bookkeeping software for a new startup and, which is not that expensive, according to your experience, to start off with?
Well, we really love QuickBooks and Xero. Both are cloud-based, so you can operate it anywhere. One of the things we love about it is when we're setting up clients here in our business, it means that we can help them with that bookkeeping. If they've got any queries, we can also log into their software and we can help them with it. So we don't know what you're selling over in Chennai, if I'm honest. In the UK, one of the core products over the years was Sage, but Sage got too far behind, and people like Xero and QuickBooks have just excelled in cloud-based accounting software. So those would be our 2 that we'd probably recommend. But if you have other products in Chennai in India that are also really good, you'd need to look at those.
Okay.
Can I answer for that as well, Dave? Can I?
Yeah.
So Frank, in India, like I have been using Zoho books for a very long time. So it's actually very Indian friendly. Like whenever it comes to the taxation, like the GST, they're well versed with the GST. And
Right.
also filing returns on quarterly GST A, GST B, whatever the GST filing per year, they're very connected to the government. So it directly routes you to the government. So I think it also depends upon the kind of business you are in. But Zoho is very good for startups, and also they support big businesses. They have head office in US and they're doing very good job. They're serving globally actually. I think you know that already, right?
Yeah. Thank you, Cross. Yeah, I know Zoho. Yes, I was just curious also.
Yeah. And Praveen just texted saying that it's not that expensive. It's very cheap actually.
Right.
That's great, Cross, because we know that what we deal with here in either the US or the UK is obviously going to be very culturally different to something that you might use. And obviously even language barriers. We tried to introduce a client from somewhere like Netherlands or Finland or somewhere, and they couldn't even convert their information that was in their own language into Xero or QuickBooks. So we're very, very aware that the product has to be relevant and suitable for your country. Any other questions? Everybody's gone quiet. Guys, I want to talk to you a little bit about potential, okay? So we had an amazing preach by Pastor Gary Snowsall the other day. I think it was about a week or so ago. And he was talking about potential. And I know I mentioned about Peter walking on the water. And that's you basically taking that chance, taking that risk. And some of you will need to take risks. The thing to remember is that you are all full of potential. And one of the things we really felt on our heart this morning is that you have to understand that it's not what people have said about you. It's not what the world might be telling you. It's not what your culture might be telling you. It's all about what God is calling you to. And those whom he calls, he equips. You know, some people may even have a fear of failure. Well, the greatest businessmen in the world failed at times. I failed at times in my business, but what you do is you get up, you brush it off, and you keep on going. You've got to be prepared to be a Peter that sinks in the water, but still gets up, still gets out, and still changes the world. And we were talking earlier when we were praying about the word in Ezekiel. It talks about the dry bones. You've got a dimension to your business that the world hasn't got. You've got a God that's in your corner, defending and building you up, giving you wisdom. I strongly recommend to all of you that you read through the book of Proverbs, because there is so many business tools contained within the book of Proverbs. You'll be amazed. If you read the Bible with a business mind, you'll be amazed how God speaks to you in business. But particularly, obviously, the book of Proverbs. And there was a thought I wrote down when Pastor G was preaching, and it said, let's move from personal ambition to godly potential. And I just feel that there's some of you that need to cross over from your business being your personal ambition and looking at it with the eyes of creating income for your family, for your home. And you need to cross over and see your godly potential. And if you're prepared to make your business a kingdom business, then just wait and watch what God will do with your business. I could talk to you for hours on here about how God has blessed me personally through business, and not because I had a clever head, because I seriously haven't. In fact, sometimes I pinch myself and think, how on earth am I, how did I get here? And it's because I've always chosen to seek first the kingdom of God, knowing that all these other things will be added. And in the midst of that, there are still times when I've made mistakes because I've maybe not focused on God, not listened to him, not sought him clearly on areas that I was going into, and I've made mistakes. But that's fine. It's not a problem. It's just a case of, it's not about what causes you to fall. It's about how you get up. And the important thing for all of you is to get up. Some of you got to walk on water today and take risks and chances. Some of you got to change your thinking from this is a personal ambition to this is a godly calling, and start calling your business a kingdom business. And we're going to be so excited to see what God will release through you all in Chennai. That's it. Any questions? So what I'm going to do, if there are no other questions at the moment, what I would suggest is that we feel free, any of you who would like to come off the call now. We'll hang around for another 15 or 20 minutes. And if anybody's got anything specific they want to ask us, let's take this opportunity. But for now, if you want to come off the call, feel free to go, and we'll just talk to those that are remaining. Bless you guys. I'm praying in Jesus' name that the dry bones of your business will take some flesh on board, and we're praying that the Spirit of God will breathe life into it in Jesus' name. Amen.
Amen.
Thank you, Dave. Thank you, Dave.
Hey, Dave. So Frank here again.
Hey, Frank.
Thought if you could share a little bit of your journey of, how you started off in business, and, how was it during that time, and what was your struggle, and, what happened to get where you are right now.
Yeah. Thank you, Frank. So honestly, my story is too long to give all of what God has done. But what I can say is this: I started out in accountancy, and God took me on a journey through different workplaces. I worked in accountancy for a while, then I worked as a finance director of lots of different businesses. And then about 15, 16 years ago, I knew that God wanted me to set up my own business. So I embarked on that, and really things were great, and things were doing well. But in all honesty, everything changed about maybe 6 years ago, and I'm just sharing this as testimony now. I had a real conviction that in my family, or through my business, I needed to tithe a certain amount per month. And I'll tell you what it was. It was $1,000 a month. And as you know, a tithe is 10%. And I was nowhere near earning the amount of finance to be able to tithe $1,000 a month. However, we felt, me and my wife Ollie, we felt that this was something that we wanted to share and become accountable to our leadership. And so we spoke to a couple of our leaders, and we told them that this is what God had said. And we left it, and we were waiting to see what God would do. And the following January is always the toughest time financially, because everybody's had Christmas and it's been very expensive. But we still hadn't seen the ability to tithe $1,000 a month. So we decided to do it anyway. And what we did is we tithed into Freedom Church in that month $1,000. And I believe that was a huge seed being sown that God was able to use and multiply years later. Because the next thing that happened was we, as a couple, we decided to rent a home that was going to be available for 10-4 church planting people. And we didn't need the size of home that we rented, but we just wanted to offer it as a vehicle for hosting, hospitality, and for church planters to come and get refreshed. And we went into that house rented. We had no finance for buying a house. We didn't really have any savings. But God opened a door of opportunity for us, where suddenly I could see that there was an opportunity for some quite big money to come into my business. And again, because of accountability, I wanted to talk to one of our leaders. So I spoke to Chris Coppock, who you all know. And I said to Chris, I need to know what to do with this opportunity, because I don't want to see this money come into my business and then suddenly think I can go on nice holidays and buy a nice car and spend it. And I wanted some accountability for that finance. So I met with Chris. We chatted and prayed. We said that we would both go away and seek God as to what he wanted to do, because I just didn't really know. And I wanted to be generous, but I didn't know how to be that, I didn't know what that looked like. I went away and prayed. Chris went away and prayed. And then we came back together, and God spoke to me in one of the Sunday morning services and said to me that it was a partnership. The business was a partnership. And I tried to make it very complicated in my mind, but God just gave me a slap and said, no, it's just a simple partnership. And so what that meant to me is income came in, the costs went out, and we paid the tax. And what was left was 50-50 partnership. And so what I did is I went to Chris and I shared this with him, and he confirmed it. He said that's what God had said to him. So we started in our business tithing that 50%. And I'm just sharing this because what God did then was unbelievable. At that time, me and my wife had no savings. We didn't own a house, but we decided this is how we were going to deal with this new income that was coming in. 3 years later, maybe 4 years, not only had we bought our own house, but God enabled us to finance our entire visa process to come to America to church plant in Raleigh. So much money came through the business that I couldn't understand it, but God just did it. And the reason I'm sharing that is because you cannot outgive God. If you've got a generous heart with God, God will generously give back to you. And I wouldn't be sat here now. I wouldn't be doing this webinar. I wouldn't be in Raleigh if we hadn't sown that seed 6 years ago of wanting and desiring to tithe $1,000 a month. And at that time, that was a one-off, and we couldn't continue that for any length of time because we didn't have that money. But several years later, God exponentially multiplied what he'd put in our hands, and through that obedience, we're able to tithe that money on a regular basis and more. So I'm not saying that to focus anything on, is nothing to do with me or my ability. I haven't got half the ability that a lot of people who are accountants have got. But what I have got is God, and God will fight your corner. He'll do incredible things if you'll put him first. And I keep coming back to that scripture in Matthew 6:32, 33. If you seek first the kingdom of God, all these things will be added unto you. He will multiply what you put in your hand. And if you read the parable of the talents, he says at the end of the parable of the talents, he says, if you prove yourself faithful in the small things, he will give you even greater things than this. And I feel that there are some small businesses maybe in Chennai that need to put those small beginnings into his hands so that he can multiply and give you even greater things than these. You might be a sole trader in a small business at this moment, but in 3 years' time, you might be employing 10 people and be selling globally $1 million a year. You have to raise your expectation and allow God to come in and do a miracle.
Wow, Dave, that was really encouraging. Thank you for sharing this.
It's a pleasure.
Testimony. Yeah, it's really good.
Thank you. Anybody else?
I think people will have questions when they look into the sheet in their private time, when they
Yes.
start working out, they will definitely have questions, I believe.
No problem at all. So the invitation is there. Me and Meg you can probably see Meg online there. This is Meg.
Hello.
So we're more than willing to help some of you guys. We're passionate about kingdom business.
Yeah.
And that's why we're doing what we're doing. And we're passionate about seeing your businesses thrive, because ultimately, guys, what you've got to remember is it's all about salvation.
Yeah.
It's not about anything else. If it wasn't about salvation, well, God, bring me home now, because I want to go. It's going to be a better place. But because we're called to make disciples of all nations, this is why we need kingdom businesses that are going to finance kingdom growth and finance church plants and see salvations, what we're seeing all over the world.
So true.
Wow.
It's great.
So I'll say goodbye then if there's no other questions.
I hope so.
I'll put in my email. But the last thing to say is, let's move from personal ambition to godly potential.
Yeah.
Amen.
Exactly.
Amen.
Bless you guys. Thank you for joining. Anybody wants to email me, do so, and we'll aim to get back to you as soon as we can with some time to bespoke design your own costings and budgets.
Awesome. Thank you. Thank you, guys. Thank you guys for this useful session. Really encouraging.
Thank you so much for your wonderful time, and thank you so much. No words. Yeah.
Awesome. Thank you, Ross.
Yeah.
Bless you, Frank. See you, Mark.
Bye.
Bye. How do I turn this in? Come on. Come on.